In this episode of Retiring Today, we're rewriting the rules of long-term care.
It's one of the biggest concerns of pre-retirees and retirees, how to pay for nursing home care or other long-term care.
A new way to think about covering the cost while continuing to invest. Right now on Retiring Today.
In today's episode, we're talking all about long-term care, rewriting the rules of how to pay for this big concern for retirees. Here to walk us through it is Loren Merkle and Abby Huntrods. Abby and Loren are both certified financial fiduciaries, and Abby is a retirement income certified professional, and Loren is a certified financial planner. And Abby, the reality is a high percentage of Americans will need long-term care at some point.
Yeah, not a fun conversation to have by any means, but statistically speaking, if you reach the age of 65, there's a 70% chance that you will need some type of long-term care. So it is an important risk to discuss and to address within your plan.
And Loren, it's something you sit down with families and you talk about, obviously, long-term care and all the other aspects of retirement planning, but there are two things that people say to you a lot when it comes to this subject.
One of the top things that people say to us is, I don't want the nursing care facility to take all my money, right? They've worked for 40 years to save all of this money. They have this pot of money that they're going to live on for the rest of their life. They don't want it to go to the nursing care facility. If they pass, they have some money left. They want it to go to their loved ones. They want it to go to the charities, their favorite charities. The other thing that people say is, I want to make sure that regardless of what happens to me, my spouse has the retirement that he or she had envisioned as well. And they're afraid of the long-term care type of costs coming in and taking that money, consuming that money, and then their surviving spouse doesn't have any money left over to live the retirement vision that they had planned on.
And Abby, when you sit down with people, long-term care, this decision is just not made, in one lane or in a silo. You make this decision along with the other guiding principles of retirement that we call the Merkle retirement method.
Yeah, it absolutely should be coordinated with all of the other factors inside your plan, because at the end of the day, your income plan, your tax plan, your investment plan, all of those different pieces are going to help determine what is the best approach or solution to address the long-term care risk. And then, of course, the legacy piece is an important part, because if you're concerned about, the long-term care costs, then you might be a little bit concerned about protecting that legacy. So it really does all work in close conjunction.
Okay, so Loren, we promised people that we'd rewrite the rules of long-term care today, but I think we still have to talk about some of the old rules too. So what we want to do is we've got 4 different ways to pay for long-term care, and we've got a couple, John and Jane. We want to introduce them. We want to take them through the 4 different ways and talk about the pros and the cons to paying for long-term care this way. So Loren, kind of set us up on who John and Jane are, and maybe talk to us about one of the ways that they could pay for long-term care.
Yeah, John's been retired for a couple years. Jane is going into retirement, so John's kind of settled into it. Jane is just excited about making that transition to retirement, and they're thinking about what are some of the risks that they face as they go into retirement. They've saved collectively a $1.5 million portfolio, and they're thinking that they're comfortable with how that portfolio is going to provide them with enough income in their retirement, except for the big what if. Because they've had family members that have gone through long-term care and needed $7,000 a month for long-term care. What if they need an extra, 10 years down the road, they need an extra $10,000 a month on top of what it takes for them to live their retirement lifestyle? They're looking at that $1.5 million saying, is this enough to do what I want to do? And then also, how do they protect the majority of that money from going to the long-term care facility, as opposed to maybe passing on to the kids that John and Jane have as well? So they have about $1.5 million portfolio. John's 67, Jane's 61, and Jane has Alzheimer's and needs care for 7 years.
And continuing on with John and Jane, let's go first into one way to cover long-term care. It's the traditional long-term care policy. Abby, people probably really first introduced these in the 90s. They were popular. There were lots of carriers out there then.
Yeah, there were a lot of carriers, and that has changed pretty significantly since then. There's been a lot of consolidation because the cost of care has gotten a lot more expensive. It's grown at a lot higher rate or faster rate than normal inflation. So there are pros and cons to each one of these solutions that we're going to talk about today. And I think the biggest advantage to traditional long-term care, there's kind of 2 main things that you'll see or you'll hear about. One is that the premium costs can be tax deductible. So if it's a qualified long-term care policy, you can actually, take that off of your taxes each year. So that's good. And then also there's a benefit there was a program rolled out called the partnership program. And it first started in the late 80s. And basically what had happened was these states were realizing that Medicaid was going to be on the hook to cover a significant amount of these long-term care costs. As long as an individual, was willing to spend down whatever they did have saved for retirement, then Medicaid steps in and pays for those costs after that. Well, with the partnership program, it really works to incentivize people to buy traditional long-term care policies, but then maintain them even if premiums or costs increase. Because what happens is, let's say you purchase a policy with a total lifetime benefit of $300,000. So if you needed care, maybe it was going to pay out $5,000 a month, but for a maximum of $300,000. So if you were in a care facility for several years, you would get that full benefit out of that policy. And then in turn, you have put yourself in a place where you're protecting $500,000 worth of your portfolio so that, Medicaid can't force you to spend everything down like it would otherwise. So as these premiums and costs continue to increase, it was a way to just incentivize people to maintain these policies that, were oftentimes getting canceled because, insureds didn't know or didn't think that they could maintain that coverage for the next 20 years.
Okay, so that's one of the kind of cons against this, or one of the pros?
It's one of the pros.
Okay.
So when, to Loren's point, when he was talking about you want to protect your spouse. You want to leave your spouse in a position where they can continue to live out the retirement vision that you had dreamed about together. If you have this policy in place and you're protecting, $500,000, then even if you go to a facility and you need 20 years of care,
sure,
you will still be leaving your spouse that $500,000 that the state can't come back after, even though Medicaid covered a significant part of your costs.
So that's one of the pros. The partnership program, that's a really good thing. But one of the cons is embedded within that piece of the conversation where those long-term care insurance premiums do increase. And in fact, a lot of our families who have these legacy long-term care insurance contracts from 10 years ago, 7 years ago, 15 years ago, what they're seeing is that they're getting notices every year that their insurance premiums, long-term care insurance premiums, are increasing. In fact, some families got notices this year that not only is it going to increase this year, but they got notices that it's going to increase the next year and even 3 years down the road. So that's one of the disadvantages of these traditional long-term care policies is your premium is not locked in, and what you're paying today is different than what you paid 5 years ago and is probably going to be different than what you pay 10 years from now. So you have this unlimited exposure, you will, of this long-term care premium because nobody knows how bad it's going to get down the road. And that's one of the other cons as well is, will you ever need to use this long-term care insurance contract? So you're forced with this decision to pay increased premiums on a frequent basis, and you don't know if you're ever going to need to use this long-term care contract. So there's some good to it, there's some bad to it. It's a more traditional way to cover long-term care risk, but there are some other ways that many people find more advantageous now to level out some of those uncertainties.
And we are going to talk about some of those other ways to pay for long-term care. We're just 10 minutes into the show and we've already been diving deep into long-term care and how to pay for it. So imagine we can get done in 15 minutes if you get to talk directly to a retirement planner. Oh, we've got a great opportunity for you. It's a complimentary 15-minute retirement checkup call. You can go to merkleplan.com and get right on the calendar of the advisors here at Merkle Retirement Planning and talk to them about your specific situation. When it comes to long-term care, we know that your health and your retirement vision are specific to you. So you can have that 15-minute complimentary retirement checkup call and go ahead and get that scheduled today. But don't go anywhere yet. We've got 3 more ways to cover long-term care coming up on Retiring Today.
Making a list and checking it twice is not just for Santa. Pre-retirees and retirees also need to make sense of the naughty and the nice of the last year to help them set retirement priorities and goals for 2021. Join Loren Merkle and Abby Huntrods on Thursday, December 17th at noon for our December virtual Lunch and Learn. Register now by visiting merkleplan.com. That's MERKLE plan.com.
Don't let the coronavirus get in your way of a successful retirement. At Merkle Retirement Planning, we are taking every precaution to ensure the comfort and safety of the families we work with. All visitors are seated 6 feet apart, rooms are sanitized and cleaned hourly, and masks are optional but encouraged. Retirement won't quit through this pandemic, and neither will we. Schedule your visit today.
Welcome back to Retiring Today. In this episode, we're talking about long-term care. We're looking at 4 ways to cover the risk of long-term care and the pros and cons of each of those options. I'm here with Loren Merkle and Abby Huntrods to discuss the options. We went over those traditional long-term care policies in the first segment. Loren, let's go to you and talk a little bit about life insurance and paying for long-term care.
Yeah, the second option is really a hybrid option between life insurance and long-term care. This option, one of the benefits of it is it alleviates the pressure of knowing how much is your premium going to increase over the course of ownership of this policy, because with the life insurance hybrid option, whatever it is you start paying, it's going to be that same premium throughout the entire contract. So you don't have to worry about these insurance premiums continuing to increase. The other advantage is if you end up not needing long-term care, somebody's going to receive a benefit from this policy because you're going to pass on, and then that money is going to go to your beneficiaries tax-free because it is a life insurance type policy. So if you need long-term care, it's going to be there to help pay for your long-term care because you're going to advance the death benefit to pay for the long-term care or to supplement that long-term care cost. If you never need it, then your beneficiaries receive tax-free death benefits.
Okay,
I think another cool feature with these life insurance type options are they can actually also provide joint coverage. So they do require underwriting, much like traditional long-term care insurance. And if you can't be underwritten, that's an issue. But it's nice to know, okay, we have this in place, for John or Jane. And if neither one need care, then, the kids receive the death benefit tax-free. So it just provides a little bit more flexibility as far as who it covers and the different uses that you can apply it for.
Yeah, and some of those joint policies pay for an unlimited amount of time. So if John and Jane need coverage or need a long-term care facility for 10 years, then it's going to continue to pay for that full 10 years, whereas a lot of the old traditional ones, after a 5-year or 6-year period, that benefit would be gone. So you're right, it does provide a lot more flexibility, and what is unique in this industry right now is it can provide for an unlimited benefit for as long as you need long-term care.
So is there an age window at which I should be looking at this then?
Well, part of the disadvantages of that type of option is it does require underwriting. So the older you are, or if you have medical conditions, maybe you're not going to get approved for it. So the younger you are, the less expensive it's going to be, and more likely you will be approved for it. But no, other than that, as long as you're under the age of 80 and you're healthy or healthy enough to get approved for the policy, you should be okay with it.
And is this one of those things that kicks in where I can pay for long-term care or in-home skilled care when we talk about the daily living activities, when I lose 2 of the 5? Is that when these will turn on and then start paying for some of that care?
Yeah, most of these will pay regardless of whether you're in a facility or you receive in-home care. So if you stay in your home, most of these will pay. If you're in a facility, most of these will pay as long as you qualify for the reduced, if you lose 2 of the 6 daily living activities.
Abby, what other cons to this kind of approach to paying for long-term care are there?
Yeah, there are additional cons to a hybrid type life insurance approach. It is probably going to be a little bit more expensive than a traditional long-term care policy would be because you're paying for both the long-term care, component of the policy and the life insurance component. And if you, purchase this policy and you never end up needing long-term care, you will likely have put more money into the policy than your beneficiaries or your kids would receive in the form of a death benefit. So hypothetically, let's say John and Jane, they invested $160,000 as a one-time lump sum amount into this type of life insurance approach. Well, if neither one of them ever needed care, then maybe the death benefit to the kids would only be $150,000. So there is a pure cost built in that you likely will not get back out of that investment if you don't use it for the long-term care.
Okay, so that's all we need to know for right now anyways on the hybrid long-term care insurance as we continue to talk about ways to pay for long-term care as you move to and through retirement. Lauren, up next we have something we call the annuity with the long-term care rider.
Yeah, this is a way to use your investment money to offset some of the risk of long-term care. And part of the benefit of this is you don't necessarily per se have these insurance premiums that you would with the traditional long-term care or the long-term care hybrid or the life insurance long-term care hybrid option. With this, you invest your money into an annuity. Most of these annuities will give you some kind of guaranteed growth on the income bucket, and then you use that income value to produce some kind of lifetime guaranteed income. But then if you lose 2 of the 6 daily living activities, that income value will, or the amount that you're receiving from an income will double for a period of usually up to 5 years. As long as you continue to lose or don't have 2 of the 6 daily living activities, it'll pay you that double amount. So it's a way that you can offset some of the risk, most of the time, some of the risk of long-term care, but you don't have these premiums. If you never need long-term care, you're going to receive the income that you would receive from this, and it'll be guaranteed for the rest of your life.
Well, and another benefit to that approach is there's no underwriting. So for those that have medical conditions and know that they're not going to get approved in an underwriting process, then an annuity type solution might be a good choice.
And people should know too, possibility of joint coverage here as well, right?
Possibility of joint coverage. You have the ability to elect whether you want this to be joint coverage at time of election. So it's not something, it's not at time of investment. You invest your money, you allow it to grow for a period of years, and then when you're ready to receive that guaranteed income, that's when you will elect, do you want it on single life or do you want it on joint life?
And how does electing this affect your tax situation?
Well, it depends on what type of money it comes from. If it comes from a pre-tax IRA, you will have to pay taxes on that income just like you would taking it out of any other type of investment from the pre-tax IRA. You're going to pay taxes at your ordinary income level. If it's money you've already paid taxes on, then you will pay taxes on the gains that you receive while you're invested in that investment. So it's all about the origin of the money that you use.
Okay, let's talk about self-funding. It sounds self-explanatory, but I'm sure there's much more to it, Abby. What does it mean and how does it work?
Well, if we want to talk hypothetically about what these costs will be down the road, we use a calculator that's provided by Genworth to kind of approximate, okay, John and Jane, you think that you're going to need, potentially need care at age 85. Well, based on inflation and what costs here are in Des Moines, we can say that historically Genworth is predicting about $19,000 a month in long-term care costs. So instead of using one of these insurance type or annuity type solutions, now we're going to just kind of invest a piece of the portfolio or a bucket within the portfolio that's pretty aggressive and just try to grow that piece as much as possible and earmark that for down the road for kind of the what if you should need long-term care. So it is pretty self-explanatory, but I think it's important to know that if you're going to go that route, then maybe there needs to be a discussion around, all right, if we want to grow it as much as possible, maybe this is the piece we take the most risk in.
Yeah, and it's all, again, that's a great point about how this all works together with your entire portfolio, your entire retirement vision, because there's a lot to think about when it comes to retirement. Long-term care, that's what we're covering today, but there's many other pieces of the retirement puzzle, and your journey is specific to you, but the more education, the more information you have, the better decisions you can make. So here is a great opportunity. We're just coming off of an election season. We know that there's a lot of things that people are thinking about, taxation and allocations, and all the kinds of things that'll be happening in Washington after an election. So what a great opportunity to look at your retirement and learn about all these changes that we could be seeing in Washington. We are calling it our post-election retirement playbook workshop. You can go to Merkle Plan right now, sign up for the complimentary workshop, and it's a great chance to look at your retirement and what's happening with your retirement journey. But we're not done talking about long-term care. John and Jane are coming back. We're going to look at the cost of these 4 options that we talked about about when we look at John and Jane's scenario when retiring today continues.
Making a list and checking it twice is not just for Santa. Pre-retirees and retirees also need to make sense of the naughty and the nice of the last year to help them set retirement priorities and goals for 2021. Join Loren Merkle and Abby Huntrods on Thursday, December 17th at noon for our December virtual Lunch and Learn. Register now by visiting merkleplan.com. That's MERKLE plan.com. Don't let 2020 derail your retirement. Join us for a live online webinar. During this webinar, you'll discover how to use market volatility to your advantage, tax-saving strategies to grow your retirement savings, and investing mishaps and how to avoid them in a down market. Register now for this complimentary webinar by visiting merkleplan.com.
Welcome back to Retiring Today. We're talking about long-term care, 4 different options for covering the risks. And now we're back to John and Jane. Time to talk about how John and Jane, pay for or fund these risks with Abby and Loren. And Abby, first up, we talked about the traditional long-term care policy. What is the cost for that?
So with John and Jane, we're gonna say 30 years from now in Iowa, again, based on the Genworth calculator of what long-term care costs are projected to be, $19,000 a month is what John and Jane will be on the hook for John's 6-month stay in a care facility and then Jane's 7-year stay in a facility. So with the traditional long-term care insurance policy, John and Jane paid $4,400 a year to maintain those policies up until using the benefits provided, which costs $132,000 total. From those policies in John and Jane's situation, they received a total of $402,000 in benefits. So that is a pretty good reward for the cost when you look at those numbers. But when we talk about their total cost for care needs between the two of them, that number is projected to be about $1.7 million. So even though they had these long-term care policies in place, they were still on the hook to pay out of pocket for about $1.3 million worth of long-term care costs.
Okay, life insurance hybrid model.
Yeah, the hybrid option using all the same assumptions, that the total cost of insurance over that time frame would be about $160,000 to receive a benefit of about $450,000 out of that type of policy, leaving them on the hook for total out-of-pocket cost of about $1.26 million.
Okay, the annuity with the long-term care rider, Loren.
With the annuity with the long-term care rider, I'm just gonna give you an example of how this works. The real numbers are gonna be based on you and your specific situation. But let's say you invest $300,000 into this annuity and you allow it to grow for the next 10 years. And after 10 years, it pays you a total of $3,500 a month for as long as you're alive. If you lose 2 of the 6 daily living activities, then that $3,500 will increase to $7,000, and you can use that for anything you want to. Traditionally, most people are going to use that to offset the cost of long-term care, but technically you can use it for anything you want. After the 5 years goes by, then that payment's going to decrease down back to the $3,500 that you'll receive every single month for the rest of your life.
And self-funding, we know that that's just what it says, self-funding out of pocket, but you want to set your portfolio up to kind of look at how to pay for that. So now let's look at John and Jane. What option should they choose?
That is the question.
Right, because I'm writing down the numbers. I was trying to think, I'll know it'll be so obvious.
It's going to be
one's
easy.
450, one's I was writing it down going, now we'll know. But it's not obvious for John and Jane, or what should John and Jane choose?
It definitely becomes a lot more obvious once we do walk through each one of these options for John and Jane, and then they can take a look at the advantages, they can take a look at the disadvantages, the total cost out of pocket, the total investment for that protection, and then the total benefit received. And for most people, most John and Janes, it does become much more evident which one is going to be right for them.
Well, and it's easy to know when we know that Jane is going to have Alzheimer's and need care for 7 years, and John is in a facility for 6 months, but those are the variables that we don't know until far later down the road. So that's where, just talking about the different options and then kind of, mulling that over, considering your circumstances helps provide the best option and peace of mind.
And Loren, the most important takeaway though is don't pretend or don't put long-term care planning as something, oh, it's not going to happen to me, because we know that you should at least have some plan in place to pay for it.
Yeah, a lot of times people will tell us, well, my plan is just go out behind the shed, right?
I've heard that plan.
I hear that so many times, and that's not a good plan. So whatever one of these options is right for you, whether it's the self-funding, the traditional long-term care, the hybrid model, or the annuity option, make sure that you weigh the pros and cons of each one of those, and then make the intentional decision so you feel good about your decision, and then it's also incorporated within your plan. So you know that if you are John and Jane, and John needs long-term care 10 years from now, that Jane's still going to have the lifestyle that she deserves, and your John is going to receive the care that John deserves. So it needs to be embedded within the plan. Make sure it works and is comfortable for you, and then you can feel good knowing that you have overcome one of the biggest risks that upset people's retirement.
And the nice thing about having all of this knowledge is it does at least give you some power when you're making your retirement decisions or working with a retirement planner. So long-term care, just one piece of the retirement puzzle. We've got a great opportunity coming up for you. We're calling it our post-election Retirement Playbook Workshop. It's a complimentary workshop that you can attend to learn about all of the aspects of retirement. There's investments, there's taxes, there's legacy planning, there's healthcare, there's Medicare. We didn't even talk about Medicare today. So go to merkleplan.com. You can sign up there for this workshop. It's a good opportunity, again, to learn about many of the aspects of retirement. And we'll talk about how the election has possibly influenced some of those aspects of retirement, some of the changes you may want to make to your retirement now as you look at your retirement vision and your retirement portfolio. We'll also continue to talk about all the aspects of retirement on this television show. It's Retiring Today, and we thank you for watching.
Making a list and checking it twice is not just for Santa. Pre-retirees and retirees also need to make sense of the naughty and the nice of the last year to help them set retirement priorities and goals for 2021. Join Loren Merkle and Abby Huntrods on Thursday, December 17th at noon for our December virtual Lunch and Learn. Register now by visiting merkleplan.com. That's MERKLE plan.com. Don't let 2020 derail your retirement. Join us for a live online webinar. During this webinar, you'll discover how to use market volatility to your advantage, tax-saving strategies to grow your retirement savings, and investing mishaps and how to avoid them in a down market. Register now for this complimentary webinar by visiting merkleplan.com.
From our family to yours, we hope you have a wonderful weekend.
We hope you enjoyed the show.
We'll see you next week.